let's finish up this discussion of working capital and financing by considering a couple of potential alternative plans for a company that's trying to decide how much short-term versus long-term debt to include in its capital structure. In this case, we're looking at a corporation, Edwards Corporation, and the pertinent details are that it has current assets of $500,000, and it has long-term assets, fixed assets. Those current assets are both permanent and temporary, but it has fixed assets of $100,000. And I've got the wrong 100 line above. So in aggregate, it's got to finance, and that's the same regardless of the financing plan it chooses, but in aggregate it has to finance $600,000. And for simplicity, we've assumed away any stock. We've just assumed that the firm is borrowing everything, which obviously is a poor assumption, but it allows us to sort of focus on the pieces that change here. So we've got $500,000 that we need to finance. Under Plan A, the firm is going to borrow short-term at 6%, $500,000. So it's going to be fairly aggressive in using short-term debt because it's cheaper. Right? The long-term debt is at 10%. It is going to have it's going to finance all the fixed assets with the long-term debt. So $100,000 is going to be borrowed long-term at 10%. That's one possibility, Plan A. Under Plan B, the firm is going to still borrows $100,000 to finance its fixed assets, but its current assets, it's going to use some long-term debt in fact, more long-term debt than just to cover the permanent. It's also going to cover some of its temporary current assets as well. It's going to finance only $150,000 short-term, borrow $350,000. So it's in aggregate borrowing $450 long-term, $150 short-term under Plan B. Let's see what impact this is going to have on this particular firm to go with a more aggressive financing Plan A versus Plan B. In each case, the earnings before interest and taxes, its operating earnings, are $200,000. But under Plan A, where we borrowed $500,000 at 6%, we see short-term interest on our short-term debt of $30,000, interest on our long-term debt of $10,000. We're paying a total of $40,000 in interest. That leaves us with earnings before interest and taxes of $160,000. We pay 50% of that in taxes, and our after-tax earnings is $80,000. If we had borrowed using much more long-term debt, we only have $9,000 in interest expense on the short-term debt, $45,000 on the long-term debt. Our interest costs are in aggregate $54,000. Okay, $14,000 difference. However, our tax rate's 50%. After we reduce earnings by the 50% taxes, we get a $73,000 after-tax earnings amount. The difference between those two is we're going to save $7,000, or we expect to save $7,000 by using more cheap short-term debt than long-term debt. So at first glance, we might say, well, we ought to use the short-term debt. It's cheaper. Having said that, this is sort of our most likely scenario. Let's assume, though, that there's also the possibility that we might have a tight money period, a period in which interest rates go up, that it's hard to borrow, that capital is scarce. If you've locked in long-term debt, you've already borrowed. If you haven't locked in long-term debt, you have to go back to the financial markets, refinance your short-term debt at a much higher interest rate. So let's assume that interest rates rise, and in particular short-term interest rates rise. We can't get adequate financing. We've got to borrow at a high cost, because if we don't, we've got to downsize our company, begin to liquidate assets. So in that case, we might want to consider, well, what happens if there's a tight money period, and just as importantly, what are the odds that that's going to occur? So for Edwards Corporation, let's assume that what we did earlier, where we saw there was a $7,000 benefit to using Plan A, that's under normal conditions, and that normal conditions happen 80% of the time. Okay, but if we have a tight money period, interest rates would rise, and we won't go through the calculations, but let's imagine interest rates rise on short-term debt, and suddenly short-term debt is our new short-term debt's more expensive than the long-term debt would have been, and so it's costing us money to have short-term financing. There's a 20% probability that's going to occur. If we wanted to assess, well, what's the expected outcome here, we would just take a weighted average. There's an 80% probability of $7,000 in benefit. We multiply those two together, get $5,600. There's a 20% probability of a negative $15,000 benefit from Plan A. Multiply those together, we get negative $3,000. We add them up, and we have $2,600, which means that our most likely scenario, which I'll circle now, the most likely scenario was $5,600 in benefit. The average scenario, expected scenario, is also positive. Given those scenarios that we're projecting, we might very well decide, yeah, we want to go with more short-term debt. Having said that, all of this hinges upon what it costs us in that tight money period. So let's imagine a different firm. It's identical in every respect. The probabilities of normal conditions, the probability of a tight money condition, the advantages of Plan A in normal conditions, but this firm decides in a tight money environment, we are one of the firms that's likely to get squeezed the most. It could be really costly to us. It might cost us an extra $50,000 a year because we're going to have to pay enormously high interest rates in a tight money period. In fact, it's going to cost us $50,000. So we go through the same analysis, taking the weighted average of the benefits, take the weighted averages, sum them up, add them together. In this case, we find a negative expected value, so the most likely outcome of $5,600 is positive, but when we consider the possibility that the most likely outcome might not occur, the expected value, or the average benefit, is negative. In this case, our firm is likely to decide it's too risky to borrow short term. We're going to lock in our interest rates for the long term and avoid the kind of problems that would occur in a tight money period. All right, with all this in mind, what should a firm do? Well, that's a complex question, and we've really seen sort of the considerations that the firm is going to, the things the firm is going to consider in reaching that decision. In general, firms attempt to match the life of the assets they have with the length of term on the debt. So matching the length of their assets lives with the length of their debt lives. Having said that, some firms are willing to take more risk. We call that a risk-oriented firm. They're willing to take more risk. They're willing to borrow short term because the interest rates on average tend to be lower, and they're willing to accept the possibility that there could be a tight money period where this is going to hurt them. In addition to borrowing shorter term, they're likely to be willing to accept on the asset side of the balance sheet a lower degree of liquidity, which might include just having less cash on hand at any given point in time, being willing to borrow more on short term if the need arises. A more conservative firm is likely to decide to borrow more long term than a strict matching would provide, and also they might have a bias toward holding more liquid assets, including potentially more cash on hand at any given point in time. So there's some general considerations, but in the end, a lot of this comes down to a decision that management has to make as to how much risk the firm is willing to tolerate. Nevertheless, it's one thing to say we're willing to tolerate more risk. It's another thing to fail to plan. And so this process that we've looked at in terms of developing cash budgets, in terms of identifying what likely borrowing needs are going to come about, communicating that information to the bank, telling the bank, look, 3 months from now, 6 months from now, we anticipate a need to borrow. Here are our projections. This is why we think we're going to need to borrow. So we will be here then. Perhaps lining up a line of credit so that you're guaranteed to be able to borrow when the time arises. There's a cost to doing that. But all of this goes into the planning. Regardless of whether the firm is more conservative or more risk-oriented, this planning process is going to be similar for all firms.